Ladies and gentlemen, good day and welcome to the Mech Projects Limited Q1FY24 earnings conference call hosted by Nirmal Bang Equities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prasheel Gandhi from Nirmal Bang Equities. Thank you, and over to you, sir.
Thanks, Lizanne, and good afternoon to all participants. Nirmal Bang Equities welcomes you all to 1QFY24 earnings conference call for Mech Projects. From the management team, today we have S.K. Ramaya sir, Director and Business Development, and Mr. Jimmy Satish, CFO. I now hand over the call to management for opening remarks, post which we can take questions from participants. Thank you, and over to you, sir.
Yeah, thanks, Prasheel. Good afternoon, all. This is Satish. I have with me Mr. S.K. Ramaya, Director, Business Development. Once again, welcome you all to the earnings call Q1 FY24. We had one more great quarter as we are seeing positive developments across verticals, including execution, business development, new talent induction, risk management, continuous leadership training, working capital cycle improvement, and cash flow. The overall performance of Mech is well within the set plan, both in short term as well as long term. Performance for the company continued to be robust. Coming to the numbers, the reported total income for Q1 FY24 is rupees 871 crores, and the EBITDA for this quarter is close to 105 crores, and PAT is close to 51 crores. Whereas during Q1 of last financial year, the reported total income was 749 crores, and the reported EBITDA was rupees 86 crores, and PAT was 39 crores. Quarter to quarter, there's a growth of almost 16%, and with the growth of the top line, the EBITDA has gone up almost 22%, and whereas PAT has gone up to 29%, which is significant. The revenue mix for Q1 is as follows. Erection business has contributed 139 crores. Civil, including railway, metro, water distribution, STP, it's around 493 crores. Operation and maintenance, both domestic and international put together, is 224 crores. And electrical business has contributed 809 crores. Whereas last year, Q1 FY23, electrical business has contributed to close to 152 crores. Civil, 376 crores. Operation and maintenance, it was around 196 crores. And electrical business, it was 22 crores. During Q1 of this year, domestic business has contributed almost like 90%, and rest has come from the international market, which is close to 10%. And power sector, power and non-power, the distribution is 51% and 49%. Q1 of last year, the contribution from international used to be 17%, whereas this year is 10%. And domestic was around 83%. And similarly, the mix power and non-power last year, it was 60-40, and this year is almost like 51-49. We have seen growth both in O&M and civil business on a year-on-year quarterly basis. Erection business continued to be flat, expected to grow post Q2. Electrical business has shown negative growth because of conscious reduction in the order booking plan. We are not expecting much to concentrate on electrical business because of its large working capital intensity. Going forward, water distribution related works, railway, metro, power projects related works, material handling and contract mining will play a major role in our business model. Of course, operation and maintenance, both power and non-power, domestic as well as international, will continue to be the backbone of the company. Improvement is also seen in overall margin profile, and same is further expected to improve gradually. Coming to the depreciation cost, as a percentage, it is more or less flat, remain lower side due to planned capex spending. Not much capex is happening. We have kept close to 40 to 50 crores, that is the level. And the finance cost as a percentage remained controlled and continue to be controlled on account of improved working capital and cash flow. With improvement in margins, we have also seen improvement in ROC and ROE, and on commencement of the revenue from MDO business, significant improvement further expected both in ROC and ROE. Coming to the other developments, during last quarter we got close to 42 crores which was held for a long time with the Andhra Pradesh Medical Tech Park. 42 crores we realized, and close to 20 crores of retention money, which is the final amount. All set now. We are expecting this to be realized next 30 days. And the average monthly collection continued to be at 350 crores plus, and we are seeing gradual increase in the collection with the growth of the business, and this is expected to grow significantly. Coming to the net current days, excluding cash and cash equivalent, it continued to be in the range of 128 to 135 days, which used to be significant 2 years back. A lot of efforts gone to bring down this number, and our immediate target is to see this number to 150 to 110 days. And coming to the debt, the gross debt and net debt remain at control level. As on Q1, the gross debt is close to 490 crores, which is flat in spite of increase in the order book and business. This number remained controlled because of the improvement in the working capital cash flow, and the net debt is close to 284 crores. And debt equity is also more or less remained at control. 31st March we had close to 0.37, and where it was 31st March it was 0.5, so it has come down significantly. So more or less it's ranging 0.3 to 0.4. Coming to the order book target, we had opening order book of almost 23,000 crores plus, and we have set a target of close to 10,000 crores for this year, including the spillover order book of 1,200 crores of last year. So we are more or less confident of achieving this number. So this target remains the same. As of today, we have got L1 status of projects around close to 2,000 crores, and projects which we have already got 720 crores. So the target of 10,000 crores is quite achievable. We have identified projects of around 40,000 crores plus. So 10,000 crores for this year target, we are quite confident, excluding the MDO part. Major target segments includes international operations because post-COVID, during COVID, we could not take much of the orders because of travel restrictions, but now the team is quite active. A lot of inquiries are coming. So we have kept close to 400 crores plus of international order book, and could be another 150 to 180 crores of operation and maintenance orders from international. Apart from that, domestic itself, we are targeting close to 1,500 crores of O&M orders. and we are seeing a lot of momentum happening in the power, especially the old plants getting revived. So we have kept a target of almost like 2,000 crores plus. On top of that, water distribution, it's almost like 2,500 crores. Material handling, a lot of inquiries are happening. So there we have kept a target of 500 to 800 crores. And specialized construction could be in the range of 450 to 900 crores. So the order book is widely spread, so the opportunities are plenty. Now each SBU in-house is quite competitive to bid for decent sized projects. Now each SBU has built their PQs and credentials. Now it is enabling the Power Mech to bid for larger projects at competitive price and without JV. So that is also helping in a big way to improve the margin profile. As you all know, like recently we have got a large MDO contract from SAIL. This is a major breakthrough for Power Mech. We have been working for 2-3 years to see that Power Mech will build 3,000 to 4,000 crores of stable income for a long term, which is going to be sustainable and which will help in a big way to improve the margin profile, because normally we used to work at 13-14% margin 3-4 years back because of so many reasons, losing for the JV credentials and all, and booking cost for the PQs and all. So we ended up working with 11.5, 12%, but now there is a high probability that the margin profile will improve with the new project. So this MDO we have got from Steel Authority of India SAIL. The contract size is close to 30,438 crores, which has to be executed over a period of 28 years. That includes 2 years of development period. The broad scope includes development of all the infrastructure, including a washery, coal handling plant, all related infrastructure which is necessary to excavate the coking coal. So we have to excavate close to 4 million tons of coking coal. The total results expected to be almost like 97 million tons. And the overburden we have to remove almost like 535 cubic meter in million. So this is a large contract, and this will change the profile of Power Mech, and this will help along with the existing MDO KBP project plus the operation and maintenance, which we are generating close to 1,000 crores of top line. So this will help us to push 3,500 crores plus from 26 onwards in a big way. So the consistent stable income 3,500 crores is now assured for Power Mech from 26 onwards. Plus now we have built credentials in railway, metro, water. Of course we have our own pie of power. So combined together we can see a large quantum jump going forward. So this MDO project we went with a JV partner called PC Patel. The structure is 74% Power Mech will hold and 26% to the JV partner. And the structure we have gone because of PQs, but the 100% project will be executed by us. So next 2 years we have to set up the washery and coal handling plant and related infrastructure. So this needs close to 800 crores of investment. And on peak we are expecting a top line of almost like 200 crores plus. And the margins from this project expected to be the largest contributor as compared to our all existing businesses. So this will help in a large way for our blended margins. The investment of 800 crores, this will be a combination of lease, some of project specific debt and internal accruals plus the equity part. We are working on multiple structures to optimize the cost and the capital structure. And one more good development is the KBP MDO. We have got the forest clearance, and recently the EC committee has approved the environmental clearance. So this is expected to receive by end of this month. So most likely October onwards, both the projects, the groundwork can be started. So for this year, FY24, quarter 4, we may expect combinedly 100 crores plus of top line. The new project of Tasra, which we have got from SAIL, this is a project where all the approvals are in place. So it won't take the process time what we have taken for the old mine. So this is a ready to start project. Approvals are in place. So we are expecting the contract to be executed next 30 days. Post that, we can commence the work at the ground. We'll mobilize the project, and we are expecting to book some revenue during this year. So the combined two projects maybe 100 crores plus. Maybe next year we can target close to 350 to 450 crores, and gradually it can go up to 2000 crores plus escalation. That is the target. And in terms of our execution cycle, it's quarter one, quarter two. Historically, it works 35 to 40% of the total year. So this year is going to be 35% coming. The revenue coming from quarter one and quarter two. 65% will come in the second half. That is how the industry works for us. So we kept a target of 37 to 40% conversion to our opening order book, and we are positive and confident of achieving that number. And FY25-26, we are seeing a good quantum jump because of the projects in pipeline. Order book is very strong. Apart from that, this MDO both are going to stabilize during this year itself. So this will help in a big way. So both the projects put together plus the existing order book and the projects that we have kept in target. So probably 35% plus CAGR we are expecting next 2 years. So by FY26 is going to be a major quantum, both in terms of our top line and in terms of margin profile also. We are expecting that we should come back at least plus to our normal margins what we used to report 3-4 years back. Yeah. Now I request Mr. S.K. Ramaya to share a few more developments before we get into Q&A. Thank you.
Thanks, Satish, for your various points you brought out about on the business, and thanks for our participants. As Satish has said, the entire business outlook looks positive and bullish. And we have seen the order backlog of 7,333 crores by end of the year. And with the addition of 720 crores, we are maintaining more or less the same backlog of orders. With mechanical contributing 6,845 crores, civil 6,505 crores, O&M nearly about 500 crores, electrical 270 crores. The power to non-power is 65% to 35%. The power side backlog is 8,781 crores. The non-power side is 4,860 crores. And the domestic segment has become highly bullish. And this is obviously the input what we are getting in terms of the national infrastructure pipeline investments, which is going on for the last 3 years, which is a total investment of 111 lakh crores. And that has been reflected in the near doubling of the orders from 2021 to 22-23. From 4,238 crores to 8,479 crores. For with that establishment of baseline of 8,500 crores of order booking last year, what Satish said about the projections for the current year of 10,000 crores is reasonably possible. That is mostly driven by the opportunities what is on hand, and lot of investments are coming in the private sector also. The major aspects of the business is that around 2,000 crores of jobs we are in the L1 position in terms of O&M, water systems, FGD, and installation jobs, and also non-power jobs. And moreover, the opportunities what is being tracked, each individual projects in various segments comes to around 25,000 crores, with installation about 5,000 crores, non-power about 500 crores, railways nearly 3,000 crores, electrical 1,500 crores, O&M 2,500 crores, drinking water about 2,000 crores, and other water systems another 2,000 crores, FGD nearly 3,500 crores, and road projects about 4,500 crores. Therefore, there is a visibility of the investments both in the public sector, the government sector, and the private sector. In all areas of the investments is going up. and railways experience, drinking water experience, and even road construction experience is pretty good for the organization because we are doing quite well in terms of conversion and implementing the project. The major projects on hand, Yadadri, what we are doing into 5 into 800 megawatt in Telangana, about 813 crores, 76% of it has been completed. Maitri 2 into 660 megawatt in Bangladesh, 855 crores, we have completed 77%. Kurungudi 2 into 660 megawatt in Tamil Nadu, 78% out of 362 crores. And Khammam Kodar Road for the 645 crores, the progress is very good. 64% we have completed. Then the other road projects we have done about 56%. Then Bhusawal project for the VHL we have done about 89% out of 256 crores. Drinking water progress is picking a lot of traction, and almost 30% of the work has been completed. Then the new job what we have taken, BMRCL, the maintenance shop work in Bangalore, about 427 crores, work has started in full swing now, and revenue should come up more in the current year. Then Monnet Spot, which is a revival project of 2 into 525 megawatt, 106 crores, we already taken up. And railway electrification job, almost 92% is completed. The opportunity wise, if you look at it, in the installation business in the power sector itself, there is going to be revival of the investments in the coal-fired plants, going to a variety of factors. One is to bring the stability in the grid. Another is to balance the base load operations. And there is a plan to, already many of the projects have been approved. NTPC is bringing up projects in Lara, Beripalli, Seepat, Singroli, Maija, Ramagundam, Patratu, 13 sets of 60 to 800 megawatt. Damodar Valley Power Corporation is bringing up a project in Raghunathpur. Haryana Power Generation Company at Yamuna Nagar, 800 megawatt. NLC Talabira is almost on the pipeline, about 3 to 800 megawatt. NLC Naiveri, expansion 2 into 660 megawatt. Then Rajasthan Vidyut Nigam Limited, Chabra and Kalisin, they are bringing up two major projects of 2 into 660 and 2 into 800 megawatt. Then Gujarat Electricity Board also is bringing 2 into 800 megawatt. Apart from that, there is a revival of thermal plants, about 12 sets of various capacities which went on a liquidation process in Monnet, Atharna, Meenakshi, Amarkantak, Indbharat, Sirpur. This is about 12 sets of 5,270 megawatts. And in this already we have made an entry in Monnet Spot, and Atharna with Vedanta we are discussing, and already we have given the offers for about 500 crores, and we are well placed there. Apart from that, Coal India Limited is planning, they are trying to become an energy intensive company also. From coal, not only coal production, they want to enter into energy generation, and that they are planning investment 2,400 megawatts in Orissa and Madhya Pradesh. Then the O&M opportunities, as Satish was telling, that is looking bullish now. We have identified about 9,250 megawatts spread across various upcoming projects in Kurja 2 into 660 megawatt, Ghatampur 3 into 660 megawatt, North Chennai 800 megawatt, Vedanta captive power plant in Hindustan Zinc Limited 182 megawatt, Raichur KPCL 2 into 800 megawatt, then Jindal power plant in Angul 2 into 600 megawatt, and Kadalur ILFS project 2 into 660 megawatt. The domestic opportunity itself is around 2,000 crores. Internationally, recently we have seen that the captive power plant we have done for the Dangote oil refinery in Nigeria, we have already taken a job of 100 crores on a AMC contract, and there is opportunities in Middle East, particularly in the Gulf area where we are well established. Last year we booked orders of nearly 150 crores in various maintenance jobs, specialized manpower services jobs, etc. And there is a scope to find out opportunities of more than 500 crores. And therefore, in terms of the overall growth perhaps 10,000 crores is achievable, and the continued investments in the government investments in drinking water, the balance 70,000 crores out of 12.5 crores villages drinking water is made available. Still 7.5 crores of households have to be provided, and there are many other water related projects in urban development and all. Those things should come in. And railways offers an excellent opportunity, and the metro rails also excellent opportunities. The present installed base of 750 kilometers, route kilometers will more than double up with an annual investment of 20,000 crores. And with our entry in railway maintenance shops, particularly metro maintenance shops in Bangalore, every city, there are about 27 cities are planned. For the presently 18 cities are there. It will double up. With that, it will go to tier 2 and 3 cities. Every city, wherever the metro rail comes, there will be 1 or 2 maintenance shops between 300 to 500 crores. And more than that, railways is coming at various schemes to improve the logistics and also maintenance shops. And more than that, the road sector, they are going to, not only the road development will be continue to grow, but they are going to put up lot of logistic parks to improve the to reduce the logistic cost. And they are investing heavily into wayside facilities, logistic parks nearly about 50 to 80,000 crores. And power sector, I told you about that. Non-power, particularly the investments will come up in the steel sector. The present installed base of 158 million tons will develop by another 5-7 years. And all the major players, both in the public sector, Steel Authority of India Limited, JSW, JSPL, ArcelorMittal, all of them are going to increase their capacities and they are lined up the investments and all. And it is expected also in the refinery segment also, this investment should come up by increasing the refining capacity, and then the gas and oil sector also. Therefore, this outlook should sustain for the next couple of years, and then the basic feature of the revenue generation will shift from the mine development operations, as Satish has told, and coupled with the increased sustained business in the O&M, both in the domestic sector, international sector, and non-power sector also. That is how the stability will come in the revenue growth, and then apart from the new opportunities, what we will get in all sectors of the business which we are pursuing as on today. Thank you.
Yeah. Prashil, you can move forward to Q&A.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, what kind of execution do you see for FY24 on the revenue side?
See, FY24, we have kept a target of 37% to 40% conversion to our opening order book. So we are on as per that plan. First off, we are expecting close to 35 to 38% conversion. Thereafter, 60% in the second half. That is the plan we have kept.
Okay. And what is the backlog number that you are referring to for that 37%?
See, the opening order book is almost close to 13,600.
Okay.
That is the base for the conversion, and we have kept a target of 10,000 crores for this year. So already L1 is 2,000 plus 720 crores we already taken. So some conversion will happen. Okay, that's going to be an upside, but as a thumb rule, 37 to 40%, that is the conversion we're expecting for the year, for the opening order book.
And you've received 2,000 crore orders, right, so far in the 10,000 crore target that we have, right?
720 crores we have already got LOA and the work started. The rest 2,000 crores in L1 status, probably next 30 or 35 days or max of 45 days, the contract LOA process would complete.
Okay. Then on the power erection side, what kind of projects are you seeing in the system?
Yeah, as I told you, the one is the revival of the thermal plants which were stuck up under liquidation. That is coming in a big way. Monetary spot has started. Now it is expected that Akarna Power in Chhattisgarh 2 into 600 megawatt. Already we are in discussion with customer. Around 400 crores of offers also we are given, and we are well placed there. And Amarkantak is expected 2 into 60 megawatt. That's a major job. Then apart from this, it is expected the present revival of the coal-based plants. I told you 22,320 megawatt. That will slowly come up. In the sense, some projects should happen. Like NLC Talbira 3 into 800 megawatt, NLC Neyveli 2 into 660 megawatt. Then NTPC is already implementing 2 into 660 megawatt in Talcher. Then Lara is coming up. It is expected it should be awarded shortly. Maybe there are certain things they are discussing with L&T, and there are other projects also. Therefore, these are the things we are looking at it, and in non-power also there is going to be opportunities in the iron ore, then coal handling plants, and also drinking water and then water systems, etc. Therefore, wherever the installation related jobs are there, both in non-power and power, things should happen.
Okay. And sir, my last question is, this MDO revenue, will FY26 will start seeing the revenue booking on the two projects, which is KDH and the sale, or FY27, the real the operator related revenue? So that will be in 26 or 27?
We're expecting some revenue to come by quarter 4 of this year itself.
That's mine development revenue, right?
It's both the MDOs, because the second MDO which we got recently, we have all the approvals in place. We need to have the contract signed. That will take 30-35 days. Thereafter, we need to mobilize the project.
Sir, I wrote that. You said 100 crores in 24 and 300 crores in FY25, right? These would be site development revenues, right? Which your...
No. This both things will happen parallelly. Site development will be, it's like our capex. And the excavation of coal per ton, what the customer has to pay, that billing will start.
Okay.
Yeah. So it's an actual revenue.
So, and you said that 2,000 crore in FY26, right?
Yeah, the put together, we are targeting close to 1,200 crores plus, okay, and plus our MDO, the existing O&M. Put together that O&M plus MDO 1 and MDO 2. So we are targeting that should cross at least 2,500 to 3,000 crores plus. Escalation is already built.
So what is this O&M?
See, the existing operation maintenance which we are doing close to 1,000 crores now, okay, that is actually long-term contracts which is sustainable. So that plus this MDO which are almost like 25 plus 28 years. These three put together I'm targeting close to 3,000 crore plus.
Okay, so but the MDO number is 2,000, right? Your O&M number is already there as a part of your 4,000 crore revenue, right?
Yeah, the 2,000 crores, this 2 MDO by 27, I think it should be close to 2,000 crores.
And in 26?
26 could be around 1,250 to 1,300 crores.
And in terms of the output that mines have to produce, they will be at peak in FY27?
Yeah, 27, yes, it will be peak at FY27.
And what margin should one assume on this 1,200 crores and 2,000 crores?
See, this MDO, there is a lot of scope to improve the margins, and this is going to be the highest segment in our business. Normally, like O&M, which normal works 16 to 17% plus at EBITDA level, and we're expecting this business to contribute more than the O&M business.
You have a fixed price which has been, you have quoted a fixed price, right?
That's per ton plus escalation, which works close to 4.5 to 5%.
Okay.
Yeah.
Thank you very much, sir. I'll come back if I have more questions.
Thank you. We'll move on to the next question. That is from the line of Mayur Bapodara, an individual investor. Please go ahead.
Hello, sir. Congratulations for the good set of numbers. Actually, my question was around we now have two big MDO orders in our hands. So, are we open to take any more MDO orders if it comes along our way?
No, sir. Now the stomach is full now. Okay, so we have to streamline these two projects, and we have got our own other operations. So at least not for next 5 years.
Okay. And sir, my second question was regarding, so you said that we require close to 800 crore investment for this MDO2, MDO, second order of the MDO. So how much we are going to fund it through debt?
We are working multiple combinations. One is the project-specific debt. Second is some equipments we can go for an outsourcing model. It's like a lease model. And some in the form of equity. So it is going to be a combination of various structures. At least 70-75% it has to come from the debt side. That's what we are planning. So probably next 1 week to 10 days we'll have more clarity in terms of the capital structure.
Okay. And sir, on the order side, so we are targeting 10,000 crores of new orders. In that we have close to 2,700 crore we already received as the L1 or like that. So from FY25 and FY26 onward for the more bigger orders like 15,000 crore order inflows, how we are preparing our execution team?
Yeah, sir, 25, 26, we have kept around 11,000 to 12,000 crores. That's the target because we don't want to increase because the bandwidth now set is close to 900 crores to 1,500 crores. Okay.
Okay.
The execution level. So gradually it's improving. Now we have got almost like 13,000 employees working with us on roll. Apart from that, we have got 12,000 employees. So in terms of infrastructure is well set. And we have kept a capex plan of close to 50 to 60 crores, which is a recurring every year we spend so that we have in-house equipment in-house. And more important to the talent, one is like inducting the talent from the big companies. Okay, that we are seeing a lot of people getting attracted to join Power Mech. A lot of like even the MDO, we have created a separate verticals and almost like more than 200 people have been recruited. And the top level more than 20 people coming from Coal India, CCL, Singareni, and that will function as a separate SBU. And apart from that, the continuous training programs, okay, to groom the middle level and young leadership. So apart from that, senior leadership is a continuous process. Now the process in terms of the in-house infrastructure is well set now to execute the projects. So to target for 10,000 to 11,000 crores of order book and the execution is well set. This 2 MDO, the team is set now. Okay. We have quite strong plan for next 3 years. Probably FY27, 28, we need to consolidate where to move. That is the plan, sir, now.
Okay. And sir, my last question is regarding, so we are targeting from FY26, FY27 close to 3,000 crore plus revenue, which will be recurring. So on that we are targeting, so in operation and maintenance, we have close to 17% EBITDA margin. And you are mentioning that in MDO EBITDA margins will be better than that. So close to 3,500 crores of our revenue will be 17% plus EBITDA margin. So overall, doesn't our EBITDA margin will move upward of 15%, close to 14-15%?
See, FY26 onwards, so there's a high probability that the margin profile, yes, it should improve. Okay, we used to work 13-14% 4 years back, so at least that number plus we should move forward. There's high potential because there is a lots of scope to improve the margins in this 2 MDO. So there is a high probability we should improve that at least 3 years back margins.
Okay, sir. Thank you and congratulations for the future.
Yeah, thank you, sir.
Thank you. The next question is from the line of Ria from Equitas Investments. Please go ahead.
Hello. Hello.
Yeah, madam. Madam.
Thank you for giving me the opportunity. My first question is in regards to the O&M order book. So, since a couple of quarters, we've seen that tapering down. So now in June quarter, I can see it's only 458 crores, while earlier it used to be around 1100, 1200 crores odd. So what would be the reason for the same?
Yes, see, madam, this the order book, what you're seeing is the residual. Normally, what happens is the contract is for 5 years, okay, and we bill it something which is subject to renewal. So we take only the residual order book. If you see, the gross order book is 2,500 crores plus.
Okay.
Yeah. So this year itself, we're expecting close to 1,200 to 1,500 crores of orders. That includes also the projects which are going to be renewed. So O&M, it works on a gross level, but we take net because that's the billing. Whatever we do, we deduct from the actual contract value. So therefore, the residual looks to be smaller.
But I think the earlier numbers are also the residual number. Like if I see March 22 numbers, the entire all the quarters were.
You're right. Because if the contract renewal to the additions, if there's a mismatch, okay, the residual number will come down, but you'll see that again it will pick up. But the gross order book is 2,500 crores. So today it's 950 to 1,000 crores. This is expected to grow at least by 15 to 18%.
Yeah, Ramaya here, what I would like to say is that, as rightly said, these are all long-term contracts, say 3 to 5 years, 2 years to 5 years and all. The advantage in this is once we are established there is every chance of 90% of renewability of the same thing in the contract, in many of the contracts. And every year 25 to 30% of the contract gets rewaived. That is a recurring order. Apart from that, the new opportunities, what we are making it in the existing profile of the projects where we can also enter because of our background and experience, that will add up to the overall improvement in the O&M. And now international market is taking shape. For example, we have taken a long-term O&M contract in Nigeria where we have done the installation work of a 400 megawatt captive power plant, more than 100 crores. And in Middle East, last year we have booked maintenance jobs and specialized service jobs about 150 crores. So that gives this one that we will be able to improve the international O&M business also. And then domestic, now there is going to be a lot of emphasis by the public sector also to enter into the long-term O&M outsourcing as a model, because the private sector is deriving the benefits. That is why our presence of 68,000 megawatts is helping us to establish with the public sectors also, like 3 into 660 megawatt Ghatampur. Then many other projects, as I told about the O&M, these opportunities are opening in the government sector also, and the private sector also renewals will come. That is one of the reasons, the present backlog will certainly improve. One information is that in the last 1 month we have received another 200 crores of O&M orders in the domestic market itself from Adani Group and also from the Reliance Infra, that is Sasan and etc. And the opportunities what we are tracking in this one, as I told you, is substantial to improve the O&M position.
Got it. And can you, actually I think you mentioned in your opening remarks, but could you tell me the debt numbers? I'm not audible.
Pardon?
Can you repeat? Yeah, debt number is it? Yeah. See, the debt is close to 490 crores. That is the gross. Okay, net is 284 crores, which is more or less what it was 31st March.
Right. Hello.
Yeah.
That's it from my side. Thank you so much.
Thank you. The next question is on the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello.
Yeah, Deepak ji, boliye sir.
Yeah, namaskar. Many congratulations, sir, for a great set of numbers. Actually, I mean, I've been looking the company for last 1-2 years. The way you have scaled up is commendable, sir.
Thank you, sir. Thank you.
Thank you.
Yeah. So my first question is on your O&M. I mean, O&M. What sort of margins we are currently doing in O&M?
Sir, it's in domestic, it's working in the range of 16.5 to 17.5, some 18%. In international, it's slightly larger, but the volume is too small. Okay, Dangote, that's the first project where we could able to crack three-digit size contract. Now, my three we have got. So that is the number. So the blended, it works around 16.5 to 17.5%.
Yeah, one more aspect in this O&M, perhaps I should have shared that. The drinking water projects, what we are implementing plus 3,000 crores. Now, once the commissioning starts in the villages providing by end of the year, there is going to be a revenue stream which will come on the O&M side of the drinking water based on the capitalized cost up to 3%. That means if the present projects are fully implemented next 1.5 years, perhaps we can get additional revenue of 100 crores in the O&M itself from the drinking water systems for the next 10 years. With escalation.
Yeah, that will be one of our initiatives.
Yeah, that is an initiative, very good initiative on the non-power.
Correct. But I also wanted to understand, is there any scope to increase the margin in O&M? Ideally, O&M does involve a very higher margin, right? So do you think that the 16-17% margin can be increased basically by?
Sir, honestly, in domestic, we have to see that that number is maintained, okay, because we have to factor the employee cost, which is almost like 64% plus of the cost, the way the employee escalation in terms of the employee cost and all, okay, inflation and all. So, but there is a possibility in international markets, sir, because we have to see how much we can scale up. At least next 2.5 years, we are targeting 250 to 300 crores of that is the size. So, with the support of international, yes, there is a possibility, but as far as the domestic is concerned, we have to see that that number is maintained.
Okay. Understood. And I understood. And when you mentioned this FY24, we are looking to convert 37 to 40% of opening order book. So 5,000 to 5,500 crores of execution level we are looking at this FY24?
So 37 to 40% of opening, and plus there could be some conversion from the new order. So more or less we are targeting that number. So because first half, maybe the first 6 months, 35 to 40% conversion. Thereafter, the residual 60% conversion should happen. That's how. So we are targeting that number, sir. 5,500
around. Plus minus somewhere.
No, it's in the range of 37 to 40 because it's quite difficult to specify any number. Okay. Yeah,
so 37 to 40% of your 13,300 something.
The range we are converting, yeah, we are planning, that's true.
But excluding MD order, right? I mean 23,000 crores minus 9,300 crores.
It includes a small portion of maybe 100 crores of additions. Yeah, that's all because we don't see much additions happening this year. It's more of like project mobilization and execution will start this year. So the big conversion will come from the next year onwards.
Correct. And post this FY24, you did mention, right, that FY25-26 we are looking at 35% CAGR, 35% plus CAGR in revenue, right? FY25 and 26?
Yes, sir.
Okay. That's quite good. And I also wanted to understand on your MDO, you mentioned O&M plus MDO1 plus MDO2. This put together 3,000 crores revenue potential from FY26 onward, which will be our sustainable recurring source for next maybe 25 plus years, right? So yes. Do we see any risk in this 3,000 crores revenue that we are looking at?
The first 2 years, because the O&M is like it's tested model. Okay, this 1,000 to 1,100 crores, which is now itself we are converting. So assuming that international may not grow significantly, 15 to 18% growth also we can reach by FY26 to close to 1,400, 1,500 crores. Plus this MDO2, because what is important is we need to develop these two projects first 2 years. Okay, it takes time only in the initial development period. Once it's done, thereafter it's like a recurring model. So we are working towards that. So what is important is like to set up the initial infrastructure, and KBP we need to set up the coal landing plant where we got that expertise to set up CSP. That is not a challenge. And second is Tasra, we have to set up washery and CSP. But having said that, parallelly the work can start. Nothing stops. on that.
Yeah.
So how to optimize the cost and improve the margins? Yes, of course, plus or minus based upon the local risks and all, we need to see once the ground reality comes. Okay. Apart from that, we don't see any challenges because we have done a thorough analysis and we have worked in past in those localities, so we understand that locality quite well. And our expertise in terms of CHP construction and material handling is more importantly, and equipment management, and then large massive earthwork where we have built that expertise last 10 to 12 years. So this will help in a big way. So I don't see any surprises to happen.
Yeah. What I would like to add, Ramaya, here is that, see, both these MDOs are linked with a very important import substitution coking coal. One is we are putting a coal wash in the case of Tasra. Another is whatever coal we are producing in the KBP project will go for a coking, coal beneficiation plant established with the central coal fields. Therefore, that is a basic advantage, and India is heavily dependent on the import of the coking coal from Australia, Indonesia, etc. And that is one of the main aims of providing these MDO contracts in a big way. And SAIL is directly doing it. Even Coal India is also doing it. Therefore, there is not should be any risk in these two projects in the long term. And Satish has said, one difference between our MDO operation and others is that we have got in-house capabilities in operation maintenance. That not many people have that. Therefore, that becomes a value addition. And apart from that, we can do the project execution much better than others because we have got strong in-house expertise in construction also. And that should add up all the better margins in the long term.
So more importantly, now see the imported coking coal, it's ranging 10,000 to 13,000, even it is plus, okay. And the rate what they have structured, it's the KBP is almost like 900 plus, and this is 3,505. So there will be a tremendous pressure from the customer to implement this project because their buying cost is quite expensive.
Yeah. Coking coal is a very, very important resource for any steel company, right?
So that is an added advantage, and both the customers are quite healthy. And so seeing all these things, there is a lot of comfort on these two projects.
Correct. Agreed, sir. Even the margins that you mentioned of 13 to 14%, right? Potential by FY26, I do see that there is upside risk. Because I think about 35 to 40% of your revenue will be driven by this MDOs and O&M, which will have 17% margin.
Yes, sir.
And even drinking water will add up revenue, recurring on the O&M.
Yeah.
Fair enough, sir. I think that's it from my side. All the very best to you. Yep. Thank you so much.
Yeah. Thank you, sir.
Thank you. The next question is from the line of Anupam Gupta from IIFL Securities. Please go ahead.
Hi, sir. Just one question. So your existing order book, almost 50% comes from the FGD projects from Adani. So if you can give clarity on what's the status on those projects in terms of execution, in terms of payments?
Around 800 odd crores we have done the ordering. The engineering issues and local configuration, because they're all retrofit projects. Therefore, naturally, some configuration, engineering and other aspects have to be lined up. Based on that, the progress will further take up.
Yeah. So maybe see, as of now, like the engineering part, okay, maybe first half we don't see much conversion to happen. Probably the second half, in terms of ground conversion, okay, that we could see in the second half only.
Okay, so when you say 36% to 40% execution, effectively includes that this should pick up in terms of execution, right, in the second half?
Yeah.
Fine. Okay. But you don't see any issues in terms of payments or project getting cancelled or any of those things?
No, it is a must. Actually, the mandate is very clear. This is the international commitment to reduce the sulfur emissions and then bring down the sulfur emissions with the efficiency of 95% collection. And therefore, 211 lakh megawatts of coal-based plants, out of that 1,69,000 identified, and more than 1 lakh has been ordered, and there is no going back, and it is a national commitment.
More importantly, it's a large-scale project, so we made, based upon our risk analysis, we wanted this project to be a cash neutral project. So at any point of time, we'll see that there's an advance clause which is interest free. So there is surplus money with us. So as part of the risk policy, we'll see that it's the complete risk is ring fenced and the cash is neutral. That is the model we're adopting.
Sure. Okay. That's helpful. Thank you.
As there are no further questions, I now hand the conference over to the management for the closing comments.
Yeah, Ramya again. I think what Satish has told on the various numbers, the business outlook, what we have brought out, and the interest shown by the participants. One is that we continue to be bullish on the market investments, both in the public and also private sector, in infrastructure, power sector, then rural development schemes are like drinking water, and then roads, and then steel plants, then mining, iron ore mining, apart from the coal mining. Then the international market should improve, particularly in the Middle East after the COVID, and that is where now our O&M presence is well established in the international market in West Africa and also in Middle East, and we have been looking for the new investments going to come up now in the Gulf area. And then Bangladesh also is going to add up capacities. So we are doing a major project, and Bangladesh plan is to get up their capacity from the present 24,000 megawatts to nearly 40,000 megawatts because they are power hungry. With all these aspects, perhaps we should look for a positive growth. And then more important is that the cycle time of implementation and learning in all the diversified areas, what we have done in power, non-power, apart from the traditional, that has stabilized now, and the manpower is well versed with the implementation cycle time, engineering management, engineering coordination, procurement, and then project execution. That should drive slightly better margins compared to the previous years, and that is why we are quite positive. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Nirmal Bang Equities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.